Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking the time out of your busy day and spending some time with us. While the markets have been quite volatile, I've been getting a lot of questions from individual investors asking about individual stocks, different sectors in the market, talking about geopolitics, oil, Middle East conflict. There's a lot going on out there for investors to parse through, and it's a difficult time. And I guess no better time to have our show today to answer all the questions, or at least as many questions as we can for all of you this afternoon. So let's put up what we're going to talk about on our show this afternoon. Fed leaves rates on hold. Was this the cause of the market sell-off last week? The Federal Reserve had their meeting, and right after the meeting, we actually saw a surge in the markets, followed by a very large downturn in the last hour between 3 and 4 p.m. And many people believe it was because of the Fed and what they didn't say, or how Kevin Warsh acted at the press conference. I'm going to actually talk a bit about a different possible reason for the markets to fall alongside with the Fed's actions. Top 3 things to consider over the next 5 to 10 business days. These are 3 ideas as we talk about on every show, very popular part of the show, where we talk about 3 things individual investors need to be focusing on when you build out your portfolios. Building a diversified portfolio. I like to talk about this every now and again because people sometimes forget that we just can't be buying all tech or all bank or all of any sector. We need to stay diversified. And when one part of a portfolio is not working, let's say it's tech, then there usually is something picking up the slack. So we're going to talk about building a diversified portfolio and the importance of having a diversified portfolio. Going back to contrarian investing. For all of you that have known me for quite some time, I'm a contrarian. I like to buy when things are not doing well, when things appear weak, especially if the underlying fundamentals are strong. And that's contrarian investing. And I think it's the best way to be profitable and to grow one's portfolio. Strong cloud services growth shows in tech quarterly earnings. I think cloud services really saved the day for a number of companies. It really turned this market around late last week, and it basically set the tone for markets this week, and markets have been pretty good so far, and a lot has to do with some of these big hyperscalers, these big tech companies, and their cloud business growth. US GDP came in a little sluggish, while Canadian GDP surprised to the upside. Nice surprise. We saw Canadian GDP a lot higher than we've seen it this past quarter, where, yes, we officially went into a technical recession in Canada. Today, it looks like we're going to get out of this recession. It was very short-lived, and many people don't even believe we were actually in a recession. Quick hits, 3 things that I've seen in the news. Most recently, I want to comment on those very briefly. And last but not least, your questions. As always, I want to take one question from our audience, and also, we have some questions, I believe, that have come in over the last couple of weeks, which we may get to some of those as well. But if you have any questions during the course of the show, please put them in the chat boxes, and we will come around and pick up those questions. And I'll be happy to answer those questions either on this show or on our next show. So without further ado, let's move forward with our show today. Federal Reserve had their usual meeting last week, followed by a press conference by the head of the Fed, Kevin Warsh. And it was quite interesting because if you looked at the markets during or just after their announcement to keep rates on hold, meaning not raise them, not cut them, but definitely not raise them, there was some fear, I guess, by many that the head of the Fed or the Federal Reserve in general would raise rates last meeting. And in my opinion, I don't think they should have raised rates. And in the end, they didn't. See, to me, raising interest rates to combat inflation that is being caused by higher oil prices, I just don't see how raising interest rates is going to fix that problem. Raising interest rates doesn't bring down the price of energy or oil. Obviously, if we had some resolution to the conflict in the Middle East, that would bring down the price of oil and as well bring down inflation. And we've seen this happen very quickly. In the month of June, inflation numbers were a lot lower because the price of oil had dropped back down to below $70 a barrel. So Why would the Fed raise rates? Well, we saw nine voting members vote to keep rates on hold, and three members dissented, decided that they wanted to raise rates a quarter point. So normally we don't see such a large amount of people dissent or not agree with the committee, but we saw a 9-3 vote. Therefore, they kept rates on hold. And so when they came out with I guess the perspective that they were going to keep rates on hold, market actually rallied. I think there was a bit of a relief rally there. NASDAQ was down on the day, moved higher by about 150 points. The Dow was higher, TSX, everything seemed pretty good. And then Mr. Warsh gave his usual press conference, and then that's when things started to fall off the rails. By 3 p.m., between the hour of 3 and 4 p.m., markets not only gave back what they had made, but a lot more to that. The Dow Jones ended up down over 1,000 points. The NASDAQ ended up down well over 500 points, and the market had a pretty large, and for many investors, a bit of a scary sell-off. And so we were all thinking it was because of the Federal Reserve. Well, in my opinion, it wasn't. And we're going to show what I believe was, I don't know if they're the main culprit, but definitely if investors are looking at the fact that inflation is high and that the Fed is not doing anything, and this could present a problem later on. We saw interest rates spike, but we also saw a major hedge fund implode, basically have to sell off a number of their stocks at low prices to cover money that they had borrowed to invest, margin call, as we call it. And that, to me, also exacerbated the fall in the markets. So let's go to our first illustration, which is the hedge funds, or sorry, my apologies, the federal funds target rate. You could see here now in the US, 3.5, 3.75. It's been that way now for a little bit. Fed is on hold. But you could see, obviously, the last movements have been to the downside. And many thought that this year the Fed would continue to cut rates. That hasn't been the case. Because that inflation seems to be running higher, and because the Fed doesn't seem to be wanting to cut rates at this point in time, the market seems to be anticipating a Fed rate hike. I should have said, sorry, market's anticipating a Fed rate hike. The Treasury bonds, U.S. Treasuries, the 2-year, the 10-year, the 30-year, we're starting to see these rates move higher in anticipation of a rate increase sometime down the road. The bond market believes the Fed's going to have to raise rates at some point. So let's go to our next chart, the 2-year Treasury, and you're going to see that it has steadily been moving higher. Now well above 4%. At one point, it was well below 3% not that long ago, back in March. Next chart here is one of the 10-year Treasury. There it is. Again, in anticipation of rates moving higher, we're seeing the Treasury well above 4.5%. 4.5% has always been a bit of a benchmark. Once it crosses that, we start to get a little bit nervous. The market doesn't like when interest rates, or at least yields on U.S. Treasuries, start to go about 4.5% on the 10-year. Let's look at the 30-year Treasury right now, and you're going to see that is now well above 5%, down a little bit in the last few days, but nonetheless, Treasuries are moving higher. This has been again in anticipation that the Federal Reserve is just going to have to raise rates. I believe Kevin Warsh, the Fed, is trying to buy time. They have all these committees that they've created to take a look at the way the Fed works, and they're waiting to get I guess the information from these committees. Kevin Warsh has said that the Fed needs to operate differently now, so he's waiting to see what these committees that he's created comes back with respect to many aspects of the Federal Reserve. And so I think it's great that he's doing that, but I think he's just buying time, hopefully waiting for the Middle East conflict to reside, to stop, to finish, and hopefully oil prices come down, and with that, inflation comes down, and that would then hopefully mean that the Fed does not need to raise rates. Our next chart is the S&P 500. We can show that here. There it is. And you could see what happened last week when the Fed, I guess, did not raise rates. You could see that blip. And it's interesting, that blip happens in and around the 29th of the month, which is last week, middle of the week, which is when the Fed meeting took place. And then take a look at what happened to the S&P 500 after that. It just shot up almost in a straight line, which is unbelievable. The market has rebounded significantly. And I think there's a reason for that. And I'll get to that reason in just a moment. Let's take a look at the NASDAQ. You're going to see a similar thing. There it is, a dip on around the 29th. Again, that is when the Fed made their announcement. So what does this all mean? The Fed reluctant to raise rates. Market gets spooked out a little bit. Yields are starting to rise. On that day, yields actually rose quite significantly. So what does that mean for the markets? Well, markets they don't really like that. But let's move to our next, our next illustration. There you go. Recent Fed Reserve headlines. You have U.S. stocks slide after Fed pause. Fed officials who voted to hike rates say action is needed now again. Now against inflation. 30-year yield hovers near 2007 high as traders weigh Fed decision to hold rates steady. So again, these are the headlines that are coming out, and that is why the market gets spooked. Yields start to rise and stock market falls. But let's move to our last illustration for this segment. AI hedge fund stumbles. A battered hedge fund founded by former OpenAI researcher Leopold Aschenbrenner is unwinding many of its trades after big losses on artificial intelligence stocks and bad bets against software stocks left it scrambling to raise cash, according to people familiar with the matter. So there was this hedge fund that was managed by this gentleman. And this hedge fund started off about $2 billion, and it used leverage. So it borrowed money 4 times leverage. So margin, 4 times margin to bring that $2 billion hedge fund to something over $40 billion in market cap for the hedge fund. So it used leverage strategies. And what did it do? It borrowed money and it bought stocks in the AI space, bought stocks in some software companies as well. And what do we know happened recently in the month of July? There was a big tech sell-off. And as the next headline says, the chip wipeout reached a climax this week, which was last week. And of the AI boom, most prescient young investors were caught at the center of it. So this gentleman was caught at the center of it. He was called Nostradamus of AI. He didn't foresee the sudden swoon that his hedge fund would have this month. So what ended up happening on the same day, roughly the same time as the Fed's announcement, this gentleman's unfortunate hedge fund, he had to sell positions at low prices to pay off his debt, to pay off his margin. He had received margin calls, and selling off a bunch of stocks, quite a number, billions of dollars worth, brought down the market. So when everybody was thinking that the Fed was the cause of the market falling, it may have been partially because of the Fed, but it was also because there was a hedge fund that was imploding, that had to sell off major positions, large amounts of stock into the market at low prices. The good news was they found buyers, and I think Apollo, private equity firm, bought the equity positions at bargain-based prices, and the hedge fund I think still is surviving till this day, but obviously much smaller. But that took down the market. So what happened? The Fed sets its interest rate policy. Market reacts negatively, but at the same time, it was a hedge fund that imploded, in my opinion, that also helped take down this stock market. So when everybody believes, oh, the market is falling because of this or that reason and getting nervous, what many people didn't know, that this was a one-time event. And if you look at the S&P 500 and why it zoomed to the moon right after Wednesday of last week, it was because once they unwound their positions and sold their positions off, the market started moving back up again, and everybody that was able to buy cheap, they did. And many investors, till this day, 5-6 days later, they were able to, so far, reap the rewards of buying some of these stocks on the cheap. So was the Fed the main culprit of last week's swoon? I would say they were a culprit. Were they the main one? I'm not so sure. I think the hedge fund imploding had a major effect. And so I guess the moral of the story is, I guess, when you see what's going on, there's a lot more going on behind the scenes for investors. And I'm glad I could bring you the information today about what exactly happened with this hedge fund and how it helped bring down the markets last week. Now, the part of the show, most popular part of our show, top 3 things to consider before you make your investment decisions over the next couple of weeks. Obviously, we need to continue to talk about the US and Iran conflict and the effect on oil prices. Well, most recent news that we're hearing is they're talking again that there could be a possible deal, etc. And even if there is a deal announced, which there can be, will it hold? Will the deal hold? 2 weeks from now, a week from now? We've had deals in the past. Are these deals going to allow the price of oil to fall back, and with that, take down the inflation rate as well? So need to keep an eye on Iran-US conflict. Second point, jobs, inflation, interest rates. We're going to get CPI, PPI over the next couple of weeks coming out of the US, consumer price index, producer price index, which are wholesale prices. We're going to get big jobs Friday. This Friday. Canadian jobs numbers come out. U.S. jobs numbers come out. What will they say about the state of the U.S. and Canadian economy? Tech spend on AI. Is it justified? The biggest question, in my opinion, for this earnings season is the tech spend that these companies are doing. Is it showing a return on investment? Is it showing that these companies, by spending as much as they are they more profitable because of it? And that's definitely something individual investors need to be focused on. So let's move to our first topic, which is the U.S. and Iran conflict. Our first illustration here are some headlines. And of course, we know the media is very big on headlines, and they play a huge part in either taking down the price of oil or causing the price of oil to move higher. The top one, Houthis push back on report of planned Red Sea shipping fees. Saudi Arabia prepares sea and possible land offensive against Houthis. Trump says he's canceling strikes on Iran, subject to deal being made rapidly. That was the other day. So a lot of headlines, and this is bringing up the price of oil, down the price of oil, which in turn is causing fears of inflation. Not so many fears of inflation. Hopefully inflation coming down, and the market reacts accordingly. I think the market has become slightly immune to some of these headlines now after, what has it been, about 5 months that we've seen or that the conflict has been going on. So the markets may not jump as quick as they used to, but make no mistake about it. We've seen oil recently pop above $90 again, only to come back down on some positive comments to end the war. Next chart that we have here shows oil prices and where they sit. Here they are, oil prices. 83.8 is Brent crude, which is your European, European price for oil. WTI is the US price for oil, and usually WTI is slightly below Brent, but they've both been coming down, going up. You can see the ups and downs. They were rising in the month of July, which is possibly why a reason why stocks had some difficulty in the month. And they've come down to start the month of August, which is why we've seen the month of August off to a fantastic start. August normally, the beginning is usually good, but by the end, we start to see markets tail off, seasonal factors, and September tends to be the worst month for the market. So we'll have to see if the markets can hang on to the gains that we've seen over the past few days. Our next chart shows gasoline prices and what they've done. There you have it. And they've sort of flattened out, right? 409 a gallon in the United States. They were on the rise and now started to flatten out once again. So you can see how this, of course, would affect consumers. Consumers have to fill up their cars, their trucks with oil, with gas. And still, there are many that have electric vehicles, but I would say many more have gasoline powered engines. And that's where you see gasoline prices right now. Let's take a look at our next chart. In Canada, gasoline prices, there you have today's average. Definitely been moving up a little bit from where it traded, I guess, a month ago. But overall, gasoline prices, again, affecting us here in Canada, elevated for sure. We've seen elevated gasoline prices now for quite some time. And so OPEC, one of the major, bodies to decide whether they are increasing their production of oil. We know the United States produces oil just over 13 million barrels a day. Canada actually is the fourth largest producer of oil right now, Saudi Arabia being number two. But OPEC recently, they announced OPEC Plus, which is OPEC plus Russia, also did its bit to calm oil markets. The cartel approved the production quota increase of around 188,000 barrels per day from September onward. The output hike agreed by core members Saudi Arabia, Russia, Iraq, Kuwait, Algeria, Kazakhstan, and Oman completed a phased rollback of a 1.65 million barrels per day cut originally agreed to in 2023. So what does that mean? Well, OPEC agreed to cut a lot, 1.65 million barrels per day back in 2023. And with this recent increase of 188,000, they've basically unwound that reduction and put things back to where things were prior to 2023. Oil prices retreated sharply, unwinding gains built on months of conflict risk. So we can see that there's a lot of oil in the world, and whether or not OPEC, United States, Russians, other countries, Canada, Venezuela, they decide how much they want to produce. But that has always been my fear with owning oil stocks. If you own oil stock today, and let's say the conflict, does come to an end officially, and we start to see oil prices fall, who knows where they could fall to? I believe real price of oil for WTI should be closer to $50, $60 a barrel than anywhere near 90 to 100. So if that is the case, you got to believe that oil stocks, which have reaped the rewards over the last little while, they've been moving up significantly, they will definitely come down with the price of oil. And so for individual investors, I think you need to be mindful of that. And that's why I always say if you're going to buy an oil stock, you should buy one that pays a dividend. That way, that dividend can continue to pay you something, even if the growth is not there. Let's move to our second topic for top three things that individual investors should be focusing on. And this is basically, jobs, inflation, and interest rates. As you can see there, jobs, really important. We're going to get jobs out of Canada and the United States on August 7th, this Friday. And we're going to get on Wednesday, August 12th and 13th, Thursday, we're going to get CPI first, and then wholesale prices out of the US, which of course will be very closely watched. We want to know if inflation is ticking higher now that oil has gone up once again. We saw it come down with the price of oil in June, but will inflation now tick higher once again? So our first chart that we have shows job creation in the United States. There you see it. It's been positive jobs, obviously, although we are seeing it coming down slightly on the far right-hand side of the chart. We've seen it coming down with each passing month, and now the expectation is for 57,000 jobs created, which would be lower than the previous 3 months. Our next chart is actually on Canadian jobs. And Canadian jobs, that's been an interesting number to look at. We are anticipating a positive number there as well. And you can see the last couple of months have been positive. Prior to that, 3 out of the 4 months were negative, which quite alarming in my opinion. And if you look back over the last 6 months, 50% or 3 out of the 6 months have been negative. So have we turned a corner with respect to jobs? Well, we've turned a corner with respect to GDP. And so hopefully the jobs will follow. Our next chart shows the CPI, consumer inflation. There you have it, 3.5, 2.6. You have the headline number, and of course, your core CPI, which is the green coming in at 2.6. Again, we always like to look for inflation to come in at around 2%. And of course, we are well above that on the headline number, and even above that in the US on the core number. Next chart that we have is PPI. These are your wholesale prices. So our wholesale price is going up even before you start to see the pricing of goods in the stores. And it's actually come down. We saw a headline number of above 6% in the US. Now we're looking at 5.5% and 5% on the core. So overall, it it's come down a little bit, nowhere near where we want to see, of course, on the PPI or the CPI for that matter. So once again, these numbers will be crucial and will be looked upon by the Federal Reserve to either further the, the push to raise rates, or if we start to see these numbers continue to fall, perhaps Kevin Warsh will tell the others, well, listen, we didn't raise. It was a good idea. And now that hopefully the war can come to an end soon and we could see oil prices start to fall back. And with that, we will see inflation fall back as well. So big numbers, big data coming up, jobs first, and then inflation second. Our third point that I want individual investors to focus on before they make their investment decisions is this whole idea about tech spending. And is it justified? Are we seeing a return on investment from the companies that are spending billions and billions, hundreds of billions of dollars every year on AI, data center, and chips and everything that goes along with it? They continue to spend, and the market is a little bit spooked by this spending. They're not so sure that we are going to see a return on investment. First, that's actually a quote that we have to show you, which I find quite fascinating. Take a look at this. One number to start your day with. I guess not to start your day, but in the middle of the day. The latest tally of how much the four largest players in the data center race, Alphabet, which is Google, parent company of Google, Meta, parent company of Facebook, Microsoft, and Amazon, have committed to spend over the coming years $2.4 trillion. That's trillion with a T. And unbelievable number. And I never would have thought that these companies would spend this much, of course. And they're spending so much. They're actually spending now more than their free cash flow, than their money that they're bringing in. And these companies bring in billions of dollars every quarter. Yet the amount of money they're spending on infrastructure, on data center, is unbelievable. It's actually more than the money that they're making. And our next chart shows Meta, which is the parent company of Facebook. This is probably the number one company that markets have been punishing for the spending. And you can see that very large drop. And that was when Meta came out with earnings in the center of your chart. And their earnings actually were fantastic. Revenues are growing at record levels, except when they said how much they're spending or about to spend on AI in the coming quarters, and that their free cash flow would basically dwindle down. Still positive free cash flow, but definitely just above positive, a lot less than what they used to have. The market punished them severely. That day, you could see the fall. They dropped about 10% that day, and it was one of the biggest falls we've seen for Meta in quite some time. So the market punished Meta for the amount of spending because the market believes that it'll be difficult for Meta to prove and to show that they're getting a return on their investment. Next chart, Alphabet, or parent company of Google. They had a similar fate. You could see their downfall again towards, let's say, the second week or third week in July. When they reported earnings were unbelievable, just like Meta's, except they too said they were going to increase spending on data center, and the market did not reward them. Don't know why. They did not allow Alphabet or give Alphabet a pass, because the next two companies, our first one being Amazon, let's show that chart, the opposite happened. Look at that spike higher. Amazon said they're spending more money as well. But I guess unlike Meta and Google, the market applauded their spending and said, hey, they're able to spend the money and they're seeing the return on investment. I think the Amazon conference call that the CEO held with all the media and everybody, I think it was brilliant. Andy Jassy laid out exactly what they're doing, and the market was very excited about it. Let's look at, Amazon. They grew data center, which we're going to show you slightly, extremely well, very, very profitable. We'll get to that illustration in a moment. Microsoft, another company that showed tremendous growth. They grew cloud business and revenue, something like 42%. AWS grew by like 37%. And Google, which the one stock that got punished, grew data center or cloud 82%. and yet the stock went lower. So here's Microsoft. They were applauded again for their spend. So I guess it just depends on which companies you're looking at, whether or not the market likes what they see. Keep in mind as well that Microsoft was coming into this earnings season at a low point, whereas the others, such as Google, even Meta, actually Meta was coming at a bit of a low point as well. So not exactly sure why those companies continue to be punished for their spending, and yet other companies continue to be rewarded. Perhaps Microsoft and Amazon were better able to communicate exactly what they're doing. Other companies like Oracle and Meta and those kinds of companies just can't seem to communicate or show investors that their spend is actually increasing profits, whereas Amazon and Microsoft can. So those are the three areas of the market, or three ideas that I want individual investors to focus on. The conflict in the Middle East, of course, jobs, Friday coming up, and the inflation numbers following week. And last but not least, the tech spend. How are these companies spending their dollars? Are they spending too much, or is it justified? And I think if we focus on those three things, that'll help when you produce or continue to build out your portfolio over the next few weeks. Building a diversified portfolio is so important. I hear from time to time investors always asking, why are you selling this winner to buy this name that has struggled? And the answer very simply is, well, I want to buy tomorrow's winners, not necessarily what's happened in the past. But at the same time, I want to continue to diversify. When you look at owning semiconductors and what happens on a daily basis, sometimes the chip makers, they have a great day. The chip equipment guys and gals have a great day. And then you see it at the expense of other sectors, whether it's software, whether it's pharmaceutical or whatnot. And then the next day, you see the semiconductors, the chips companies, they fall at the expense of software going higher, pharma going higher, banks going higher. And you tend to see this push and pull with the market as of late. And that just tells me that we need to continue to be diversified. Obviously, we want everything to go up and we want everything to work. And it actually has been that way now for quite some time. But at any given day, you're going to see something go down, something go up. And that's just the way it works. Nothing goes straight to the moon and nothing makes money all the time. We always have these setbacks or pullbacks. Our first illustration shows all the different sectors of the market. And you can see year to date, everything's in green. That's the column in the middle. 3-month, communication services down slightly, utilities down, staples are down, materials, which is your gold stocks primarily, that's down. But you're seeing other things moving higher. 1-year number, everything has been moving up. Some things obviously a lot more than others. You're looking at information technology. Looks like that is the highest, 30%. Infotech is your tech names, your big cap tech names. That has led the way. Our next chart shows that things actually have been broadening out. Different asset classes doing better now. And here you have it. S&P 500 is in the yellowy line there. The Russell 2000 index, these are your small caps, now doing well as well. And then your equal weight index, S&P equal weight index. And what that is, your Russell is actually doing the best. That's in black versus the S&P equal weight is in gray. So doing better than the S&P 500 index in general. And so equal weighted S&P just says that all stocks on the S&P 500 are of equal weight. We know that's not the case, right? Some stocks are bigger than others and have more of a weight on the index than others. But if you were to take the whole index and weigh them all the same, big names, small names, big companies, small companies, and you were to equal weight everything, give everything an equal balance, what would the index be producing? It actually would be making more money right now than the index that has names that have more weight than others. And that's what that chart is showing you. Let's take a look at our next chart here, which is one of tech or software in particular. There you have it. You can see the ups and downs. Again, do you want to own some software? I think so. I don't think AI is going to replace names like Salesforce, ServiceNow, Microsoft, in Canada, Constellation Software. Some of you may be familiar with that. And you can see lately that we've seen a nice run up in software stocks. Next chart that we have, when you're selling semiconductors and, you're looking at what to buy, well, what are you buying? Where's the money been going? Well, I can show you it's been going to pharmaceuticals. Look at that chart in pharmaceuticals. That sector has been left for naught, right? Nobody, really that I've been talking to, they haven't been too excited about pharmaceutical companies in a long time. But I guess there are a bunch that have been, because the market has driven up the prices of some of these pharma names. And we own, and my clients own a number of pharma names. Some of the biggest names have been on a tear. The Bristol Myers, the Mercks, the Pfizers are even starting to move higher. Pfizer recently just reported really good earnings. So money coming out of semiconductors going into pharma. And where else is it going? Well, it's going into banks, U.S. financials. And let's take a look at our next chart. There you go. Look at that chart on U.S. financials. If I didn't show you that headline, you would probably think that that was a tech chart. But no, it is U.S. banks, U.S. financials, insurance companies, financials. And then we could look at the Canadian financial sector, our next chart. And again, a pretty good chart. So this is why you want to be diversified, because when something is going up, unfortunately, something is going down. You need to be nicely diversified in many different areas to offset. Our last chart will show you, now that you see all these great charts, let's take a look at the semiconductor chart that we have for you, and it is going the opposite direction. So for the longest time, between April and let's say June, or sorry, the beginning of July, end of June, the semiconductors were on a roll. Now we're seeing them fall back at the and we're starting to see other areas of the market surge. We need to stay diversified. Now we're seeing finally the semis bounce back a little bit on the far right-hand side of that chart. So stay diversified. I know there's an urge to chase these hot stocks, to follow the herd. It never works. It might work in the short term, but over the long term, being diversified and having a diversified portfolio always wins out. Going back to contrarian investing, as I said off the top of the show, I've been a contrarian investor for most of my career. You want to buy low to sell high. That is the famous saying. You want to buy things that will be tomorrow's winners, not yesterday's winners. And I get often asked, Allan, why are you selling some of the names that are doing so well and you're buying names that are struggling? Well, I'm buying those because I think they're struggling for not the right reasons. And in many cases, companies' shares, the price of those shares does not accurately reflect the underlying fundamentals of a company. I think in many cases, companies' shares should be higher. They're not trading higher. And that to me represents opportunity. And so you want to be a contrarian investor. You want to buy when others are selling, and you want to sell when many are buying. That is the way to do it, in my opinion, if you truly want to have a nice growth, or to build a nice growth portfolio. First illustration we have for this segment are, I guess, some definitions, if you will, key takeaways, they call it, on contrarian investing. Contrarian investing involves making investment decisions that go against prevailing markets, as I just said, with the aim of profiting from price movements when markets overreact due to emotions like fear and greed. Prominent figures such as Warren Buffett, Michael Burry, embody contrarian strategies, often betting against or in favor of the market sentiment when it diverges from an asset's intrinsic value. As I said, when they think an asset is valued higher than it is showing, and that's when they want to buy. A major challenge for contrarian investors is accurately identifying undervalued opportunities, which requires extensive research and a deep understanding of fundamental analysis. That's what your investment advisor should be doing for you. Lastly, contrarian investing shares similarities with value investing, as both seek to capitalize on market inefficiencies by acquiring assets believed to be undervalued based on their intrinsic value. So again, this is the way I think individual investors should look at investing. Our first chart that we have of a stock is Micron. And you could see Micron had been moving up, up, and up. And then at some point, investors just said, how far can Micron go? And started to sell the stock. If you were a contrarian investor, you would have been trimming profits in Micron. I have been doing that for a number of clients. For some clients, not necessary, but for many, I have been. And then now that Micron is well below its 52-week high, perhaps it's time to look at buying Micron, perhaps when others are selling. NVIDIA, our next chart, you will see NVIDIA has started to move a little bit higher, but prior, I guess, to the recent climb, NVIDIA really didn't do an awful lot. As NVIDIA moves higher, again, trim some profit, move it elsewhere. And if you did this over the last year with NVIDIA, you would have been rewarded for it because NVIDIA has not really grown that much. It's gone up a little bit, but nowhere near what other names have gone up. Microsoft, our next chart. I've been looking at Microsoft. We've talked about Microsoft a number of times on our show. It has been a fantastic opportunity. It has been trading at some of the low points we've ever seen from Microsoft, or I've ever seen, on an earnings per share basis. And lo and behold, they came out with earnings, and a huge spike in share price of Microsoft happened because this name, in my opinion, was very cheap. A lot of people were selling it for various reasons. And if you were a contrarian, you would have been a buyer of Microsoft. Another stock here outside the tech space we have is Blackstone. Blackstone is an asset manager, one of the largest asset managers in the world today. U.S. company, owns a lot of real estate that has data centers on it. They've been making a lot of money in the data center space, making deals with several companies to open up or to have data centers on their property. And you can see Blackstone hasn't done an awful lot. Earnings have been tremendous. They just came out with great earnings, and they talked about how their investments have continued to grow. Lockheed Martin, our next chart that we have, again, in the defense area, U.S. defense, maker of fighter jets and Patriot missiles. And again, you could see their chart had a nice spike in the middle, came down an awful lot, I think too far, and well off its highs. And again, if you were a contrarian, you would have taken a look at Lockheed Martin. So for me, being a contrarian investor means you want to buy when those are fearful, and then be greedy when those are fearful, and then you want to be fearful when those are greedy. A very famous saying by Warren Buffett. He's said this many times, and obviously many of you would recognize the quote, but that is true, and that is how you make money, in my opinion. It's the Warren Buffett style. I know Warren, or Mr. Buffett, he obviously has the buy and hold mentality. We don't. I don't believe in the buy and hold. I believe you buy, you set your targets, and when those targets are reached, that's when you decide to sell some, sell all of the investment. So be a contrarian, in my opinion, is the best way to be. It takes an iron stomach, but if you can do it, it can be very profitable. So we saw some fantastic earnings out of the companies that are right in front of you there: Microsoft, Alphabet, and Amazon, based on cloud performance. Their cloud growth, their revenue from cloud is just ginormous. When you look at an Alphabet growing 82%, it's unbelievable. The one-day gain in Microsoft when they came out with their earnings was just unbelievable. Actually set records, and we actually have our first illustration shows how much Microsoft made that one day: $449 billion, $500 billion, the largest gain in market cap in history of any company. And the stock actually went up 16%, which was the largest gain since I think 2007 for the company. But because Microsoft today is, we're talking, $3 trillion company, when you go up 16%, you make a lot of money, and there is a lot of growth. Our next illustration shows, as I've been saying throughout the show, how much these companies, their cloud business meant for them. Alphabet, 82%, cloud services growth, Microsoft, 43%, and Amazon, 37%. Understanding that if you reverse that chart, Amazon is the biggest cloud business, followed by Microsoft, and Alphabet is right behind the two. Amazon AWS, as many people would know it, is the largest. Azure, Microsoft is next, and then the Google Cloud is next right after that. And so it has been very important. In my opinion, the cloud growth really saved the day for these companies, allowed them for the most part, and Alphabet kind of unfortunately didn't happen that way, but for Amazon and Microsoft, they turned this market around late last week with the announcement of their cloud business. Their stocks ran up tremendously, both of them double-digit growth. And Alphabet actually recently hasn't had a bad run either, up a little bit in the last few days. And so I think the market is really focusing on their cloud growth, and so it should. And if these companies continue to see the growth in that space, then I do believe that the spending on AI, the hundreds of billions of dollars that these companies are spending, will be justified. And I think the market will reward these companies over time. US GDP, I guess one word to describe it, sluggish. We were coming off a relatively strong GDP number at the end of last year. The US had, this is by the US, by the way, US had a great number, about 4% growth in GDP at the end of last year. Now we're down to 1.5%, whereas in Canada, we're coming out of a technical recession where we saw negative growth in the country, in GDP. And now we're finally seeing some positive numbers, some growth in our country. Our first chart shows US economic growth. You can see it there, 1.5%. Last quarter was 2.1%, 0.5% only. And then you see the 3.8 and 4.4, very, very strong. And you can see 2024 and 2023, GDP was much, much stronger. We seem to be, our United States seems to be dwindling right now, whereas other parts of the world is perhaps a little bit stronger, which is not what President Trump would say. He would say the economy in the U.S. is extremely strong, but the numbers don't really back that up. Let's move to our Canadian numbers, Canadian monthly GDP by industry, and we want to see. Last time we saw a positive number, it was mainly because of the oil sector. The oil and gas extraction, and still that is a very large part of GDP. But now you can see manufacturing is up and construction is up, which is interesting. I guess that would be the spending by maybe our federal government kind of plays a factor there. And you have all the other industries as well. So right now, Canadian GDP coming out of a first quarter recession, I think GDP was positive for the months of April. Looks like May was again another positive, and now first indications is June is positive as well. So I guess we can probably celebrate that we are out of the technical recession, but just how well is our country doing? A lot of people would say we are still struggling, and I agree with that. I think until we start to do something to make our country more attractive for foreign business, we're going to continue to struggle. And we talk about this on our show all the time, cutting taxes, cutting interest rates even further. I think these things would go a long way to helping GDP growth, especially GDP per capita in Canada. Quick hits. 3 things that I've seen in the news over the last couple of weeks that I wanted to comment on briefly. First one, China's AI models are shrinking U.S. lead. We always consider the AI or United States as being the dominant country in AI. Well, China is definitely closing the gap. Number 2, major oil companies reap massive profits as U.S. and Iran fighting drives energy prices higher, oil prices higher. President Trump commented recently that companies like Exxon and Chevron should not be making this amount of money. Our third point, why the U.S. stepped in after decades to prop up Japan's yen. What's at stake? What's at stake for the United States? And so we saw the U.S. helping Japan recently. U.S. Treasury helped Japan prop up the yen. Let's move to our first quick hit. China AI models are shrinking the gap, but the U.S. lead. And our first chart that we have here shows this. And what this is showing is price per 1 million tokens of select AI model outputs. And you can see how expensive ChatGPT 5.6 is, Claude, Kimi, which is the latest, one of the latest ones out of China, being a lot cheaper. Gemini is even cheaper. Grok is even cheaper. And now ChatGPT or GPT 5.6 Luna was reduced from $6 to $1.20. And DeepSeek, this is the company that is being talked about most. If companies are able to access artificial intelligence at that cheap a rate, whereas all other companies are producing it at a much more expensive rate, then DeepSeek will be the winner. The fear is that everybody will start to use companies like DeepSeek and stop using American companies. So we need to keep an eye on what's going on with respect to AI over in China. Our next quick hit, talking about major oil companies and how much money they are making. And we have our one chart for this segment, which shows just how profitable. There you have it, how profitable these companies are. You're looking at ExxonMobil and Chevron. Chevron is the darker line, ExxonMobil, the lighter line. Look at those profits spiking and taking advantage of an opportunity. President Trump is not happy with that. And I'm sure many of us at the pumps are not happy with that, especially in the United States as well. Our third quick hit is about the Japanese yen, talking a bit about where things are at. And we have our US dollar chart for that. There you go. And when the US started to prop up the yen against the US dollar, you could see what happened to the US dollar. It started to fall off. And I don't know if that was the intention, but that's what seemed to happen. We talk often about this thing called a carry trade, and that is borrowing yen and investing in US, or I should say the other way around. You could take US dollars and invest in yen because the yen is much weaker and it gives you a lot more bang for your buck. And that's what we see quite often. It's called the carry trade. So 3 things in the news that I've seen over the last couple of weeks that I wanted to comment on, and something I'm sure that many of you have seen as well. What's my take? This is a part of the show where I take one of your questions that I've received over the last couple of weeks or from our audience. I wanted to take one question that came up, I think about 2 days ago, and it reads like this, and I'll actually read it for us now. I have some extra cash. Is it better to pay down my mortgage faster or invest the money? So a very brief or general question. So this person's asking, should they pay down their mortgage or pay off debt or actually invest the money? Well, simple answer is it really depends. I guess maybe it's not so simple, but it depends on mortgage rate. What is your mortgage rate? If your mortgage rate is 6%, 7%, then I would say paying down debt makes sense because investing to make 6, 7% is not easy. Now, if your mortgage rate is, 2%, 3%, now if you would instead use that money to invest, making greater than 3% for this investment to make sense definitely works. And I think you can make more money than 2 to 3% over the long term investing in moderate risk investments. So I guess what it comes down to is, what is the interest rate on your mortgage? What is the interest rate that you have on your debt? And if it makes sense, usually it means that your interest rate is lower and that you would be able to make more money in the markets than you have to pay on your debt. So with that, I want to say thank you to everyone who tuned in to our show this afternoon. As always, thank you. And we will be back in 2 weeks' time, same place, same channels, across all social media channels. And that is on Wednesday, August the 19th, I believe it is. And we will be talking about the markets, what's going on. I'm sure new headlines will be coming about. We're going to see obviously different things with respect to geopolitics and how they affect the markets, and obviously a new top 3 list that we're going to bring to you as we do every time. So until the next couple of weeks or for the next couple of weeks, I want to wish everybody happy investing.